Good afternoon, ladies and gents. Welcome to LAT's weekly market insights. It's Friday, the 6th of October. I hope you've all had a good week and enjoyed some trading opportunities. And there's been plenty of moves in the markets this week. If we come across the economic calendar, and really this week has been dominated now once and for all this afternoon by non-farm payrolls, which has been a big beat on expectations. Non-farm payrolls today coming out at 336,000 versus the consensus of 170,000. So not only was the consensus in the wrong direction, but it's then a large build on the previous figure as well of 227. And it's very much in this instance, good news is bad news for markets. The narrative from the Fed of being higher rates for longer, that narrative being supported by the fact that the economy is still showing remarkable levels of strength. We can see here that in non-farm payrolls. We also see it through yesterday's figures in initial jobless claims. And we also have exports in the US, their trade balance significantly higher, and their exports showing tremendous levels of growth. So all of this positive data right the way through the week, really. Even the ISM figures, services, PMIs, and factory orders also are positive. The one negative figure was actually the private sector and ADP. But generally speaking, broad-based strength across US assets, and really it was back at the start of the week on Monday with the manufacturing PMIs that got this move going, coming in at 49 versus the 47.7 predicted, and nearly getting back up to that benchmark 50 figure in the US. Now that all of that data provoked pretty significant sell-offs across the board. Gold getting hit particularly hard. We can see in the top left up here, gold breaking down very heavily. Looking back from really now when September 20th, we were trading around the 1945, 1950 handle. We're now sitting a little over 1800 at 1820. It's just seen a bit of a slowdown in the past couple of days, but a big significant sell-off. It's also the same within the bond markets. Yields soaring higher at the moment, and that dragging here just the 10-year bonds lower. And that's of course on a pricing and expectation, but perhaps the Fed could look to raise rates one more time into year end. It's a similar story then for equities. Equities here also lower, again rates higher for longer, that hawkish narrative coming from the Fed, and no data this week to really suggest anything otherwise. And the final big blow and influx of negativity just coming off the back of that non-farm payrolls figure today. We can see that accelerated move lower from 42.60, dropping down about 40 handles down to 42.20, and just pairing those losses now and just trading somewhat flat towards the lows. Of yesterday, but again, just puts continued ongoing pressure to the downside. Also, an unraveling in oil. Okay, we'd seen severe buying pressure in here of clear macro data. There was Saudi Arabia and Russia cutting their 1 million barrels per day until the end of December within this rally. There was also a reduction in the number of rig counts, and also a significant reduction in oil inventories. All of that supporting this significant move higher in oil. Now that became a very overcrowded trade, and we've seen a big unraveling of that here, partly in risk-off flows and just global demand shrinking, along with a general risk sentiment within equities and so on and so forth. But we've also seen a slight build in oil inventories as well, which has just supported oil, which is just sitting in and around now that 82.50 handle. Significant moves across the board. I think oil in particular presented itself with some fantastic trading opportunities. We'll just have a quick look at how well potentially we could have been looking to get short in around this $90 a barrel handle. Now, of course, $90 a barrel is a significant round number anyway within oil, but also alongside this, we had a beautiful downtrend, a succession of lower highs and lower lows. And when we moved back up into this trend line for the fourth time, we also had a particularly nice Fibonacci retracement as we moved back into that 61% retracement zone. Coming off that level, multiple ways to have entered into this trade, but I think one of the one of the sort of the cleaner, simpler ways to go about this was looking at the break of a counter trend line, whether you had taken this sort of less aggressive counter trend line, or if you had tried to sort of squeeze the price marginally more aggressively up through here. Either way, I think either counter trend line would have been valid. For me personally, I'm not a huge fan of this one. I would be looking to take this slightly less aggressive counter trend line, or alternatively remove that completely and look to get some shorts back through key support. And the key support level for this counter trend really was around this 89.35 handle, where we can see previous resistance broke, became support, support again, and then ultimately down through those lows. And the market then really accelerated to the downside as people started to unwind a lot of that longer term positioning. Also supporting this move down was the fact that this initial sell-off prior to the sell-off we just looked at, and we had also broken down and closed beneath this previous higher low. So the uptrend had technically come to an end at that point. That was on Tuesday of this week, which just facilitated and aided the fact that this market could potentially come lower once again. So pretty significant moves in the markets this week, actually. Very much risk off flows, very much focused towards strong dollar and higher rates for longer, and the economic calendar really taking center stage. And the final, as we said, that final sort of crescendo towards the end of the week, non-farm payrolls, putting any sort of doubt to one side really here, but good news very much being interpreted as bad news. Now, along the way here, we also had the RBA in action. Now, they kept rates on hold again at 5.5%, so a somewhat dovish tilt from, not really a tilt, just ongoing dovish commentary from Australia. And again, all that's done is aid a market which could very comfortably go down with the risk off flows that we're seeing anyway, but it just supported the ongoing downtrend that we're seeing in the Aussie dollar. And this key resistance level that came up to be challenged last week, we saw significant selling, continuation of that selling through Tuesday and Wednesday after that rate release. And again, now we're starting to see just a little bit more selling. And again, it's twofold here. Yes, it's a technical level, it's previous support becoming resistance, but it's also being aided again by risk off flows hitting these commodity currencies such as the Aussie, and also dollar strength as that flight to safety. And so with the narrative as it is at the moment, further downside for the Aussie looks like a pretty reasonable trade, and it's just a divergence at the moment in central bank policy. Aussie, the RBA have very much taken a more dovish approach, whilst the other central banks, in particular the US, are taking a more hawkish approach. So the RBA there, they took their stance. That was on Wednesday morning or late Tuesday. How do you want to break that down? So a relatively action-packed week, actually. China, of course, out of action, national holiday for the week. They will be back in play soon, but it didn't stop these markets moving. There are opportunities within the bond markets, commodities space, equities, indexes, the currency markets. There was a move just about everywhere. I guess the last thing for us to have a look at is just euro dollar, sort of the driving force for a lot of the moves that we've seen, and this ongoing downtrend now just continuing. And I think it would be worth, actually, let's just have a look back at the setup that presented itself on Monday, right back at the start of the week, those which were sort of quick out of the blocks. They had a great opportunity to look to get short euros or long dollars right back at the start of the week. And it came from this little retest up here. So we had previous lows in place at the 106 handle. Support broke, became resistance. Now, of course, clear ongoing downtrend in place here. Again, similar to that oil trade, we had a really nice Fibonacci retracement, not back up to the 61% this time, but a move back into the 50% retracement. So a nice 50% retracement back into previous support, becoming resistance. A relatively simple technical setup here. And just leaning on the fact that this trend being so aggressive and so strong. Coming down into the lower time frames, sort of an hourly chart here. So looking at sort of almost a sort of 1 to 2 day hold with an hourly execution. And we were also presented with this nice head and shoulders formation. So left shoulder, head, and the right shoulder, the neckline for that, connecting those lows either side of the head, putting the neckline through here. And this was, of course, a reversal of this very short-term counter trend to enable us to continue going short with the major trend. So high probability trade, reversal of counter trend, continuation of major trend. We could have looked at a relatively simple technical here for entry through the neckline, stop loss above the highs, targeting back down to the low. So euro dollar, although being very much fundamentally driven here, with as we said, higher rates for longer, dollar strength, risk off flows, pulling this lower, a pretty clear technical setup to go with that. And actually, if we just allow this to play through to current price right now, we've seen a very similar conclusion again, once again here, where this market has just retraced back up into actually very similar place to the neckline of this head and shoulders, and then the non-farm payrolls data just giving that dollar strength to let this start moving lower again. And I guess the next question here will be, have we got strength to run down into these previous lows down through here? And one thing that might sort of limit that slightly is if we just have a quick glance towards some profile analysis within euro dollar. Let's just have a quick look towards some euro dollar analysis, bring these profiles in. We'll have a look at market profile briefly and volume profile. Let's just get this set up. Talks about this a lot with our students. Our students currently on the program, on their programs, have just been through volume profile and market profile analysis. So students were able to capitalize on some of these setups this week. But what was quite interesting is euro dollar had a very significant sell-off. We're all aware of that sell-off. Just adjust this one last time. Follows. We're all aware of the significant sell-off in euro dollar. And as we made our way down towards these lows, we dropped down to the 104.50 handle. That was effectively where the lows got put in. And as we got down towards those lows, euro dollar put in this really nice balanced day. So sort of an accumulation day really at the bottom of the trend, some large positioning being built in here, a nice bit of balance. An opportunity, therefore, with that to either look to break through the lows for continuation or reversal and trade back up through these highs. Now, given where we are in the context of the larger picture and this big sell-off, it's very reasonable to expect a slight pullback and a slight correction. And supporting that also is just these single print areas back up through here, very low volume areas. We've got effectively this day through here was a thin day, no real agreed value area. So expectation for the market to trade back up through that, potentially spend some time and build some volume in these low volume areas. And that's exactly what we've done. And prior to the sell-off today, you can see the volume market profile and then the volume here just coming in to plug that gap, completing that single print and building volume back within the volume profile area. So 2 or 3 days here, just a little correction back up in euro dollar before then almost completing the puzzle here and then seeing that dollar strength continue through. So whether you'd been trading with primary analysis, support, resistance and trends, if you'd started implementing Fibonacci, relatively simple technical analysis, or you had started introducing volume profile and market profile, there were trades to be had here across the board. So excellent trading week. Well done to you, those of you that managed to capitalize from that. Those of you that didn't, of course, do not fear. The markets will be there next week, so will we. And we'll catch up with you again on Monday. And no doubt Mark will be back with you to give you a pre-European rundown and start of week rundown as well. So please do tune in for that. And I'll speak to you all very soon. Bye for now.